welcome back to our channel, documenting our journey to financial freedom. This is the first video in what should be a monthly series of videos tracking our family's net worth. I'll share our number and I'll try to place it in the wider context of the net worth of US families. I also explain how I compute our net worth and why I do not stick with the conventional methods. Finally, I'll go over the growth of our net worth over the last 6 months and how that shapes our goals for 2021. Let's get right into it. Our net worth, computed early 2021, was just shy of $400,000. That is a lot of money, but how does it fit in the general landscape of US households? Well, we do actually have data. Every 3 years, the Federal Reserve Board publishes a report about the overall financial health of US families. It is called the Survey of Consumer Finances, or SCF for short, and was last conducted in 2019. About 6,500 families were interviewed. If we look at the numbers published in that report, the overall average net worth of US households is just below $750,000. That is quite high. But a second value is also provided, the median. The median net worth of US households is just above $120,000. So why the difference? Which one do I think we should use as a reference point? Okay, let's take a step back and imagine we are surveying 7 households with their net worth indicated on top here, from $5,000 to $1 million. You obtain the average or the mean by dividing the sum of the values by the number of values. Maybe a more intuitive way of thinking about the mean is to imagine weights on a ruler and finding the balance point. The general takeaway is that the mean is heavily influenced by outliers, that is, the very high net worth households. The median, on the other hand, is the value separating the higher half from the lower half of the data. It is the middle value and is way more robust to outliers. It gives a better idea of a typical value. So I suggest we continue exploring the data in the Survey of Consumer Finance by looking at the median values. It is interesting to compare our net worth to other households that have similar characteristics. The survey calls out, for instance, age and home ownership, which we will look at in just a few moments. It also underlines that a family's net worth tends to rise systematically with income. Higher income families have higher levels of savings as well, and that results in a positive feedback loop. Further characteristics pointed out in the survey include whether or not you live in a city, your ethnicity, and your level of education. As we mentioned, you should really compare your net worth to the median in your age category. Net worth tends to increase with age, before stabilizing and even decreasing slightly at retirement age. This trend is very encouraging for us. We're well above the median for our age group and have quite a bit of time to grow. This is reassuring for us because we felt that we started on this journey pretty late in life. If we look at the distribution of net worth by education level in a little more detail, we can see that households with the same education as my husband and I, that is a college degree, have a median net worth that's just about 25% lower than ours. Honestly, the combination of our high incomes and our education level is quite favorable to us being able to reach financial freedom. We are really in a position of privilege and we are very thankful for that. Another factor the survey calls out is home ownership. Investing in real estate and becoming a homeowner is a very traditional stepping stone to building wealth and achieving your financial goals. We are really grappling with this idea, trying to figure out if this is the right path for our family and for the Bay Area, as we do not own any real estate yet. Okay, so how did we compute our net worth? Well, to obtain your net worth, you need to determine the total value of your assets and of your liabilities. You get your net worth basically by looking at what you own minus what you owe. That begs the question, what is an asset? And of course the follow-up question, what is a liability? So I'll share the conventional way of thinking about assets and give you my take on this. To get the value of your assets, you need to know how much cash you have in your checking and savings account or money market accounts, as well as how much you have in certificate of deposits or bonds. Also, look at your investments. Check your tax-favored accounts, including HSAs and retirement accounts. Cars and real estate also appear as assets by most definitions. The bottom line is that an asset is anything that puts money in your pocket. By that definition, I do not count any jewelry or valuable. I also consider cars a little differently. For instance, we pay insurance, gas, maintenance, tolls, etc. So we are definitely putting money in our car, but it's not putting any money in our pockets. So I do not consider our car as an asset. Although we do not own real estate, I'd like to share my thoughts on real estate and in particular on how to think of your house. This really comes from the book Rich Dad, Poor Dad by Robert Kiyosaki. For a conventional homeownership setup, you will have costs associated to owning a house. Think about maintenance costs, for instance. But your home does not put money in your pocket. It follows that it should not be counted as an asset. There are, however, ways to go about home ownerships that turn that around. For instance, there's an approach called house hacking, where your home does provide income. We are trying to see if house hacking can make any sense for our family in the place we live in. Okay, so what assets do we have? Well, we have a cash reserve of a little over $130,000, which include our emergency fund, our sinking funds, and the start of a down payment. We also have almost $78,000 in investment, mostly in mutual funds. And finally, almost $186,000 in our retirement funds. The performance of the stock market, and to a lesser degree, our efforts at spending intentionally, have really helped us see the growth of our assets. For reference, I've included the values we recorded 6 months ago when we first started tracking our net worth. All right, let's move on to liabilities. Liabilities include credit card debt and other consumer debt, any car loans or student loans, as well as your mortgage. A liability is anything that takes money out of your pocket. Both my husband and I dislike the idea of carrying any debt and have been lucky enough to never have been in a situation where we would need to resort to debt to fund our needs. So our liabilities are at zero. Honestly, there are probably ways to use debt smartly, but as a family, we are very risk adverse, so changing that mindset will probably take some time. To recap, we get our net worth by adding our assets and removing our liabilities, getting to a net worth just short of $400,000. To end the video, I want to quickly give you an idea of how our net worth has grown and what we could be aiming for in 2021. Over the past 6 months, our net worth has increased by $130,000 with a very strong market performance. We think it is reasonable to aim for a $200K increase over the next 12 months. Of course, we'll need to adapt our goals if the stock market goes haywire. This means that for the end of 2021, we are aiming for $600,000. This is a huge deal for us, going over the $500,000 threshold. We'll see how that goes and report that on our channel. What is your net worth? What is pulling you up? What is slowing you down? And I am curious, do you think real estate would be a good next step for us? Let us know. Goodbye for now and take care.